So without further ado, we're going to bring on James Baker and David Horner to talk to us about the investment company. Just to sort of recap, James is the manager. David is one of the non-execs, so we're very lucky to have them both here today. James has been with Chelverton since 2014, where he sort of manages a number of funds. He's a Cambridge history graduate and has over 30 years of sort of equity market experience on both buy and sell side, but he sort of specialised for all of his career in UK and small and sort of mid-cap stock selections. David has a sort of similar pedigree, a well-regarded fund manager, also sort of specialising in small and mid-cap quoted and sort of SME unquoted investment with over sort of 30 years experience. Chartered accountant by trade, he has sort of held senior positions at Deloitte, 3i Corporate Finance, Strand Partners, etc. Gentlemen, are you there?
We are. I'm here, certainly, Matt. Yeah.
Excellent, excellent.
So,
Yep.
so I founded Chelverton 26 years ago. Unusually, we launched with an investment trust, and within a year had a second investment trust. So we are passionate, and Andrew, who has put up with talking to me over the years, knows that we are very, very enthusiastic about the investment trust sector. Our second fund was an income fund. It was an income investment trust, which is still around. Chelverton UK Dividend Trust increased its dividend for the last 14 years, and this will be the 15th year which it does so. Our performance there was interesting, and people liked it, and they said, "Where is your open-ended version of this?" And so we went down the open-ended, the OIC route with several funds, and that's when James joined us, and we launched a growth open-ended fund. 4 or 5 years ago, I was very keen that we launched a parallel investment trust mirroring James's his team's fantastic performance on the open-ended fund. And so we did all the work to launch the proverbial £100 million investment trust in 2019, to only be stymied by obviously the onset of the pandemic and COVID and so on. I left it for 2 years and was just set to go again. And then a gentleman in Russia invaded Ukraine. So that knocked that on the head. And I figured someone was trying to tell me something at that point. And so I decided we would take control of another investment trust or a small public company and turn it into an investment trust that was going to basically follow our investment process, i.e. James's investment process. We could go to slide 2, please. So I came across, I saw that the investment company, which is the second oldest investment trust, which has a nice sort of ring to it. I saw at 7 o'clock one morning that it had decided it was going to return all its money to its shareholders. It had about £15 million. It was a tiny investment trust. And so by 7:30, I'd contacted the chairman, Ian Digay, who you see there, the quote from him. And by 8 o'clock, we'd agreed a deal. And the deal was that all the shareholders could get all their money out, and that anyone who wanted to stay could stay, and that would be fine. But we would be moving to the growth strategy as outlined, as occurred in the OIC. We raised a bit more money at the time. So the point now is that Chelverton, the company, and Chelverton, the employees, own some 29% of it. So we are emotionally and financially committed to this investment trust. Of course, with only having an investment trust of 7 million is completely crazy, and Andrew would be telling you in all sorts of presentations that it's not viable and it doesn't work and it's not appropriate and it should disappear. Well, what's going to happen with this? Our vision for this investment trust is to gently grow it over time. Not to go and raise 100 million, because firstly, I don't believe that would be practical or possible. And we don't really want to do that because with our 29%, we also want to make as much money as we can. Hence our alignment with the other shareholders. There are 2 issues with tiny investment trusts. And that is, one, the expense ratio is obviously out of kilter because there's a high level of fixed costs. And so Chelverton, and we've done this when we've launched our open-ended funds, we put in an expense guarantee. And so that means that somebody who puts in £1,000 into a £2 million fund would be charged the same expenses effectively as if they were putting £1,000 into a £100 million fund, i.e. they are not affected at all. So Chelverton subs this investment trust every month to ensure that the expense ratio stays at no more than 2% at the moment. In turn, Chelverton will not claim any management fees until it gets below 1.5%. And as a consequence of our management fees, the expense ratio will never go above 1.5%. The second issue, which is something we'd like to do more about, which is obviously the liquidity and the discount. The income investment trust, Chelverton UK Dividend Trust, has been trading at a premium now for about 2 years, bar a few weeks about every 6 months. And those few weeks are when the NAV rushes upwards in a dramatic fashion, and the share price is left for a period languishing until people spot that it's trading at a 5%, 7% discount and start to buy the shares again. I understand from stuff I've read from the AIC that there are 23 investment trusts trading at a premium, and I'm delighted that Chelverton UK Dividend Trust has, for virtually the whole of the last 2 years, been trading at a premium, and that has enabled us to issue modest issues of shares to meet the demand in the market, basically. So we want to grow the IT steadily over time. Obviously, the people on this presentation, by definition, are sophisticated investors, because investment trusts are not the investment choice of the entire world. And I think you will understand what I'm talking about is that whilst the NAV on the investment company has moved ahead quite sharply, but the share price has not. And that's because it's hard to buy the shares, but also we have not enough interest in the particular fund that's this small. So what I'm going to do is, if we could go to slide 6, please. Slide 6 is going to just put a picture on the team of 3, how clearly to assemble these excellent three gentlemen. So James is on the left. You can see he's the senior member of the team. Ed joined us, I can't remember, maybe about 8 years ago, 7 years ago, James. And Henry's been with us about 4 years. So we have a nice range there, nice continuity, nice succession. On their open-ended side, they have 2 funds, and they're running over 700 million in that particular area. And the important thing about that is that when James launched the open-ended fund, he was able to buy smaller, under-researched public companies that people overlooked or people couldn't buy. And of course, as he succeeded and more money flowed in, it was harder and harder to buy smaller companies. You can appreciate, because of the redemption issues with an open-ended fund, or indeed the scale, in that he needed to put 10 or 20 million pounds into a particular company. And if the company was only capitalized at 50 million, that was not appropriate. So why we're so keen on investment trust is that it enables us to really look down into the small cap world. And as Matt said earlier, with the introduction of James and myself, that's what we've been doing for 30 odd years. And that's what we enjoy doing. And we like finding small companies that have been overlooked or have had a problem, but we can see that the problems have been corrected, but no one else has picked up on it yet. So the other thing about investment trusts, which we like, is the ability to gear. So there's the 2 real important features that we like is one that you can buy really tiny companies and hold them, and you can plan your portfolio on a strategic basis for a year or two, which sometimes it isn't possible to do on an open-ended fund. And also one is able to gear. Now, if we could go to slide 3, I know I'm sorry I'm jumping around, but it's keeping you awake anyway, Matt.
Absolutely.
You were up all
Absolutely.
night following the election. Now, apparently, James should be talking to you about this, but apparently under the vagaries of the FCA, I have to be delegated to actually do it because I'm a director of the investment trust. The first thing I would like to say, which is not on the slide, is that Chelverton does not invest in FTSE 100 stocks. So unlike almost every other investment fund manager in the UK, we do not buy FTSE 100 stocks. And indeed, particularly on the income side, if a company is moved across, I never say up, moved across to the FTSE 100, we're allowed to hold it until it's paid its next dividend, and then we have to sell it. So no FTSE 100, which immediately sets us apart from every other fund. What we're trying to do is to capture the small companies effect, which I'm sure you've read about and heard about, which was identified by Professors Dimpson and Marsh when they started their studies, when they went back to 1956. And in summary, what the small companies effect as identified is that over time, small companies beat large companies. The evidence is pretty clear over time. What we're trying to do in this fund is to generate returns with less downside risk. When anyone thinks about growth and small companies, they immediately there's a sucking in of teeth and so on, sucking on teeth. The risk is too high. Well, we try to minimize the risk. We're targeting companies that can grow sales faster than GDP, so small companies can move faster, and that they can fund their own growth from their cash generation. It's pretty easy to become a big company if people want to take up your shares and you go and buy loads of things. We are not keen on companies that issue lots of shares. Shares are equity, as Andrew was explaining about the regional REIT thing earlier. I mean, that is a big equity issue, but you can see why they're having to do it. But it is destroying the value of the existing shareholders, but they have no choice. And we do not like companies that issue too many shares. We like companies with high margins, with sustainable competitive advantage, i.e. moats around their business that is hard for people to get across. So finally, the investment process. So if we take 1,000 companies, say, we put them through various filters to obviously take that 1,000 companies down to a manageable population that we can then review in more detail. So the first thing is it's free cash flow of at least 70% of net income, revenue growth of at least 2.5%, net debt to EBITDA of less than 2 times, gross margins greater than 20%, and finally, working capital intensity less than 30%. So all of these move you to a certain type of company that can produce high returns. So the objective is to take that 1,000 companies, put them through the filters, and then come up with a population of 300, 350. I should say each company must have at least 4 out of 5 of those points. And so at that point, having exhausted my slides and my numbers, I will hand over to James, who will talk you through the market and what we consider the excellent market opportunities at the moment. One thing I should say also is I am investing my money personally, as are the board of TIC, into TIC. Because we've seen the track record of the Chelverton Growth Fund, who are number 1 over 10 years, and we are in this for the long haul. as you know, investment trusts are not something to buy and knock out a month or two later. They should be used as instruments of long-term investment. And that's why we're so enthusiastic as to the instrument and this particular fund. I hand over to James.
Okay, thanks a lot, David. And yeah, I might shuffle the pack as well, actually, Matt. And
No problem.
there's a slide which shows the IA oil companies' excess returns over the IA oil companies, which is going to be about in the appendix. It's this one. So we'll do this one first because this is really just highlighting the small cap opportunity, which David was talking to. And this is just a comparison. It's not looking at the Numis index or anything like that. This is the comparison of open-ended funds in the IAU company, small company sector. So it's sort of representative of small cap performance against the IA UK all companies sector, which is very much weighted to large cap. And the point here really is that in the past 50 years, so we're going back in history here, but I can remember the oil price shock in 1975. I don't know how many people can. But going back in those 50 years, small caps have outperformed large cap funds, in 28 of those 50 years, and sometimes by quite considerable margins. Now, small caps don't, perform poorly against large cap peer groups in periods of economic stress. And I refer back to the 1975 oil price shock. We can see that there. I remember very well because I just started in the city, the kind of high inflation period that we moved into in the late 1980s. 87, 88's interest rates had to go up quite dramatically again. And once again, that was a very poor period for small cap returns relative to large caps. So it's really in these periods of economic stress, when the market goes risk off, the cost of capital goes up, it's more attractive to leave your money in the bank, that small cap equities come under pressure. The financial crisis was another period. This is less about inflation. This is more about economic risk, with banks pulling credit lines to lots of companies across the UK and across the globe. And then, of course, we've had the sort of purple patch when we've had low inflation, a lot of inflation exported to China with its low-cost manufacturing base, which a lot of through this century, we've had a pretty easy run apart from the financial crisis, up until the end of 2021 when inflation started to creep into the system in a meaningful way for the first time really in 20 years, initially caused by the pandemic supply chain disruption. We all thought we'd get over that in 2022 as things normalized, but then, as we know, Mr. Putin came in and created. Then we didn't just have a supply issue; we had a demand issue as well because the price of everything was going through the roof, and that sort of provided a very poor period for small cap performance, which ran really through till about October of last year. But as we've come into 2024, I think you'll find if there was a slide, if we could go through to 2024, I'm not sure why it's not there, but we'd be back in the blue again for small cap performance. So we might just pop back a slide now and look at the economic and market backdrop. What's going on in the market at the moment? Well, after two very tricky years, which I've just referred to in 2022 and 2023, inflation was stickier for much longer in 2023, but then it started to come down quite dramatically. Things seemed to be moving in the right direction, but then we went a bit risk off again when the Middle East crisis broke out in October, and that was really the nadir for the small cap market then. But what we've seen going through from there is that inflation has been falling, pretty dramatically. And the other helpful thing with inflation falling dramatically is that, in 2022, wages were trying to keep pace with inflation. Consumer confidence was badly dented. People were getting one-off helpful payments from employers to keep pace with inflation. We had quite high pay awards. But what we have now is inflation having fallen away. We're talking to companies all the time they're talking about sort of 3 to 5% pay awards, most of the companies we're speaking to. So you can see with where inflation is now, we're back into a period of real wage growth, which is helpful for the consumer. The mortgage market, the house transaction market was totally blown out of the water by Liz Truss's surprise budget. People we speak to, like the mortgage brokers who we talk to, they just saw all activity pretty much ceasing in the UK housing market. That from the tail end of last year has been much more active coming through into this year. Now, if someone's buying a flat, they put in an offer, they have to do this sort of protracted process of conveyancing. They then get their keys to their flat. They then look in it for a while. They recover a little bit of their finances, and then they want to put in a new bathroom. They want to buy a new sofa. They want to change the kitchen. This usually happens about 9 months after the housing transaction. So our feeling there's quite a lot of pent up sort of interest in the consumer economy for consumer spending to start coming back on. We haven't seen much of it yet, but the backdrop feels a lot healthier. Savings ratios are quite high. And then on the other side, equity valuations. Well, equity valuations were supremely depressed back in October last year. But in our view, and it's our view, they still offer very good value, particularly at the small and medium-sized end of the market. There's been a decent rally. So we're possibly starting to price in our view, a little bit of a recovery in the economy, but it feels like that economy should come through. And why are we confident that share prices are attractively valued? It's not just us. We're seeing company directors feeling their shares are too cheap. Companies with strong balance sheets, a lot of them are going through share buyback process at the moment. If you go through your morning RNSs on the London Stock Exchange, you'll just see a raft of share buybacks going on from a multiple number of companies. And then the other thing we've seen over the last 2 years is that, the UK market has been particularly unloved, and I'll come to that in a second. But you've seen a raft of takeover activity from private equity, just picking off good quality UK assets at the bottom of the market on relatively cheap valuations. Private equity, that is, and overseas trade buyers. So those two things sort of make me feel confident that we've got it right when we think the UK market is still attractively priced. And then what I haven't put on here, but I think is a sort of an issue that's been an issue really for the last goodness knows how long, 10, 15 years in the UK market, is really the sort of gradual de-equitization of the UK sort of investment mindset. Because when I started working in the city, it was quite a long time ago, pensions funds had 40, 50, 60% of their investment in UK listed assets. You're lucky if that's 4% now. Wealth managers, they can't resist Nvidia. I don't blame them, but they feel a lot of them that it's not all of them. A lot of them we speak to still have relatively decent weightings in the UK, but a lot of wealth managers who think that if the UK is 3% of global GDP, that's what you should have invested, or 3% of the global market. That's what your investment should be in the UK. They see it as a bit of an irrelevance in what they see as a global economy. And obviously that sort of disinvestment from the UK hasn't been helpful. It's not been helped by regulation, where the regulator sort of, transparency, I think, is the most excellent thing, but focusing just on cost and on liability matching rather than capital growth is not a good thing for our domestic market. And I think our domestic market is very important for the health of the domestic economy. So, we're just seeing a few chinks of change now. We had the Conservatives bring out the British ISA, that's helpful. But I think it just moves the dial a small way, but it's at least a change of mindset, and I'm hoping the Labour Party are going to be sticking, to their manifesto commitment to start increasing investment from pension funds into UK markets. If we've only got to move the dial a bit, and if we start getting inflows rather than perpetual outflows, suddenly the UK market will be a very, very attractive place to list your business and for investors to make money. So I think we need sort of people to be, to take on more risk, and to see the advantage of capital growth. And I'm hoping that might change a little bit as well. So what I'm trying to say is that small caps have had a terrible 2 years. The economic conditions are improving for them. And at the same time, we might just see the dial shift in terms of what the perception is of the UK market from, the fund allocators. That's all I really had to say.
Excellent. Thanks. That's a super summary. I think we'll just jump in, conscious of time, just jump straight into the questions. Got one related to that. Will Chelverton and the investment company benefit from the changing of political parties in government?
Well, I think we both got a view on this. Labour has made itself electable, in my view, by moving to the centre. And they haven't actually, they only won 34% of the vote. So it's really the Tories destroying themselves, which has let them in with a very large majority. They've tried to paint a very business-friendly agenda and a relatively market-friendly agenda, and quite often markets do very well under Labour governments. So I'm not saying the market will do any better, but I don't think it, if they stick to their manifesto, then I don't think it's necessarily going to do the market a lot of harm. And that witnessed the fact that the market hasn't moved today. I'm sure David has a view on that as well.
Yeah, I mean, I would say, I mean, as on my introduction, Matthew, you said I'm involved in quite a lot of unquoted companies. So I see monthly management accounts of tens and tens of companies. And in my view, much of the UK stuff we're invested in is doing well.
Yeah.
And what we need is, and it was said, I did stay up very late watching a lot of it, and it was the gentleman whose name I've now forgotten, who was MP for Swindon South, who was very angry, and he said we need less soapbox opera politics. And I trust that in sober-sided Sir Keir Starmer and his colleague Rachel Reeves, we will just see steady, little change and just consistent performance. Then companies can plan ahead, and there's none of these knee-jerk reactions caused by emotional upsets all over the place. Business just needs consistency and to know where they are, and they can get on. Once they know where they are, they can manage. Okay.
That's actually good opportunity to sort of answer this question that kind of relates to the regulation, which we touched on already. Somebody's asked, how do you deal with the fair value issue under Consumer Duty as big platforms like Fidelity do not appear to offer your trusts?
Right, I need to answer that. I mean, I try and when I set up Chelverton 26 years ago, compliance took me approximately 5 minutes a month. We now have a full-time employee who, in fact, 1.5 employees. So in my view, if you have a dog, don't bark yourself. All I want to do, and all James wants to do as well, I know, is run the money and to meet companies and invest the cash. Those other aspects, I'm afraid, our view is if we produce really good returns, then everything else will look after itself. Our problem we have as Chelverton is that our trusts are on the small side, and as your questioner is probably asking, some platforms won't list small investment trusts because they're concerned about liquidity. My view is that anybody on, as I said earlier, I have a strong view of caveat emptor, and also that anyone on this presentation is a sophisticated investor and knows that if they're going to buy shares in a small investment trust, they're probably going to make some money, but they may be difficult to sell when they choose to exit. And if they leave it a few years, they will probably be fine.
Yeah, okay, that makes a lot of sense. I mean, in the meantime, if I've understood your presentation correctly, they're getting you guys for free. Is that right? In effect?
Effect, yes. Obviously, Chelverton Asset Management does make money, and we are investing in this investment trust at the moment because firstly, I want to invest in it. I want it to be there so I can invest my money in it. And what I really want is like-minded people to come along. We would like to increase the size, and we have stated this publicly, so there's nothing profound in this. Of 20 million would be good, because at that level, it doesn't cost Chelverton any money, because the expense ratio would be the right number. If it takes us a year or two to get there, then so be it. If we can do it in 6 months, then obviously that will be helpful.
Yeah, that makes a lot of sense. So I guess just related to that, presumably if you are able to grow this, then presumably, there's plenty of room within your universe to do this, provided that it's done at a sort of sensible pace. With your 29%, would you be happy to sort of effectively be diluted over time? I know you're generally not a
absolutely
fan of dilution, but in this case,
no, absolutely right. I mean, no, this is critical. I'm really glad you asked that, because what I would like us to do is to raise some more money in the future. Chelverton and employees and friends and whatever might not take up 29%. If they took up 20% of a new issue, then clearly our overall percentage would drop from 29 to a lower number. That would then give us scope to buy in the market if liquidity was needed as a buyer of last resort. So I would really like that to happen, so that we can always virtually always arrange for someone to exit if the house, I think the FCA say if the roof falls in, some people may have to sell their shares.
So in the meantime, they're getting you for free. You're very, very well aligned, but you're happy to make way for other people. That's really what we're saying.
And also, I know that James is frustrated because he would like a little bit more money, or probably a lot more money, because there's so many excellent opportunities out there. And one of the beauties of investment trusts is that in order to buy, you have to sell. Typically, and therefore it's a very strong method of control of the quality. So if you see an interesting new opportunity, it has to beat every other company in your portfolio, otherwise you don't invest. James, what would your view be on that?
Yes, it's an interesting new discipline for me, because up until now we've been open-ended, so we've either had to be net sellers or net buyers. But yes, I think it's always good to examine your portfolio and see if you need to take some profit somewhere to make way for a more attractive investment. It's a very healthy way of keeping your portfolio primed for performance, I think.
Right. So all about keeping it focused, in effect.
Yeah.
Okay, we've got a sort of question here, just on interest rates. We've obviously talked quite a bit about the sort of negative impacts of those today, as obviously they've gone up. Somebody said, do you think there will sort of be a change when interest rates or further interest rate cuts come through? You've just got a sort of view on that, how that impacts your portfolio, the sort of companies you've got?
Yeah, it's got to be helpful, because the returns on equities then look more attractive against having a safe 5% in the bank on cash. Anyway, that's in the first instance. To David's point, we typically wouldn't have a lot of highly geared companies. He said we like to, in his presentation, sleep at night. So there's not necessarily a lot of benefit from interest, sort of less interest to pay in the portfolio. It's more a macro driver for equity performance.
Yeah. Did I see in the presentation there is a focus on companies that have got sort of decent, say, free cash flow generation, so they can fund their own growth, et cetera, et cetera?
David?
Yes, absolutely. It is interesting that the Income Investment Trust has about 80 companies 78 companies in total, 20 of which are in common with the growth fund. And it's really what you do with so the companies that generate cash. In the Income Investment Trust, they choose to pay half of it away as dividends, but in the growth fund, they choose to use it to enhance future growth prospects. And I've always said to James, in 10 or 15 years' time, it would be really interesting to take the first portfolio he put together when he launched the open-ended OEIC 10 years ago, and see how many of them have become out and out in dividend stocks, because cash flow is absolutely everything.
Yeah, that sort of makes a lot of sense. Conscious of time, just sort of perhaps time for another couple of questions. There is sort of question here. Have you directed your attention more towards sort of, I guess, technology orientated stocks as that's become sort of a lot more important? We had a particularly strong run, or is it just kind of business as usual?
The process, I'll take it, lends itself to technology stocks because they tend to grow and they tend to be very cash generative and they tend to have recurring visible revenues. So it's always lent itself to having a fair swathe of technology stocks, and that's been pretty consistent.
We've got a sort of question here on gearing and cost of debt, etc. Obviously, you did reference that one of the advantages of this is to sort of use the gearing. How is that sort of structured?
So at the moment in this particular fund, it would be too risky, in my view, to take on any debt. We do like debt in the income investment trust.
Yeah.
It's actually a split capital trust, and I've lived with that now for 25 years, and I think it's the most, when managed properly, it is the most brilliant, and modestly, it is a brilliant form of gearing and to great benefit to ordinary shareholders. I think in this particular fund, when we get to 20, 30, 40, 50 million, in my view, as a director, I would probably want modest level of debt, like 5 to 10 million, which would be dipped into at times when what particularly happens, I've observed, is that there are a lot of there is this when IPOs happen, there's a whole glut of them happen, and it might be that you don't have quite enough cash to take up that extra really interesting one, and you could then you would use gearing for that particular purpose as a transition from I'm going to take up this particular stock and put £1 million into it or whatever, and then over the next 3 to 4 months I'm going to sell bits of my other holdings when certain things happen. So it'd be more like a transaction-based level of gearing rather than, as in the income investment trust, a core level of gearing.
Yeah, makes sense. Probably just one last one, because we've talked about the sort of open and the closed-ended funds. If you're sort of comparing your like with like here, what do you say are the sort of key differences between them?
Sorry, between
your open-ended funds and obviously the closed-ended ones.
Absolutely. I mean, it's more obvious on the income side where we have the income OIC and the income investment trust. So I can tell you exactly because I live with this. In the income OIC, the average weighted market cap is 950 million. So that's across the whole portfolio. That's the average weighted market cap, and in the investment trust, it's quite a high now, 410 million. But you can see there's quite a bit of difference between them, even though they have about 42 companies in common. It's the ones that are not in common that stretch the difference. So in the OIC, because you're concerned about possible redemptions, they have much bigger companies, so they have more companies over 1 billion in market cap. Whereas in the investment trust, we have a lot more under 100 million, and that stretches that difference. And the same would apply in time between the growth OIC and the investment company. When it gets bigger, that will be the difference. The investment company will have more smaller companies because it can.
Brilliant. Okay. I guess probably time to wrap up there. Just sort of one last thing. I mean, why these funds now?
James, do you want to talk to that?
Well, I think I was trying to sort of cover that with the macro and the kind of long-term small cap outperformance effect. You know, we've had a very tough period because of high inflation. You know, banks do well in inflation. Retailers, grocers do well. The supermarkets do well. Initially, kind of raw material companies do well. These are all big cap sectors, and small cap, it's risk off and they don't perform well. When you get interest rates falling, you get a return to economic growth. That's when investors typically want to re-engage with small and mid cap growth. And that's, and if we think that inflation's, going to settle down at these sorts of levels and that net interest rates can then come down from elevated levels, i.e. more in line with inflation than twice the running rate of inflation, then that paints a very attractive backdrop for small and mid-cap investing.
Brilliant, thanks for that. It does sound like an interesting time to be looking at these. Obviously, we wish you all the very best with that. Hope to see particularly the little one grow. Obviously, hope we can get you back in a year or so's time, and you can tell us how it's all going.
Well, we would really appreciate that. Yeah.
Okay, right.
Okay.
As usual, obviously, here's the disclaimer. If you've not got sort of time to have a look at that now, there obviously is some important information there. Sort of please come back and have a look at that at your leisure. And then finally, just to let you know what we've got coming back, or coming up. Next week, we've got Kenneth McKenzie of Target Healthcare REIT to talk to us. And then 19th of July, Chris Clothier is in to talk about capital gearing. And then final one in July is Henry Butt to talk to us about AEW UK REIT, which had some results out this week, which look quite interesting. And see, obviously, we're already backfilling for August. So obviously, thanks for joining us today, and we'll be back. See you next week. Bye for now.